This is Nightly Business Report with Sue Herrera and Bill Griffin.
Amazon doesn't love New York. The company cancels plans to build its second headquarters in the Big Apple after mounting opposition.
Retail surprise. Sales declined in December at their fastest pace in a decade during the most critical month for that industry.
Coke goes flat. The soda maker expects sales growth to slow this year, and shares saw their biggest drop since 2008. Those stories and more tonight on Nightly Business Report for this Thursday, February the 14th.
Good evening, everyone, and welcome. One of the nation's biggest companies is saying goodbye to the country's biggest city. Amazon has confirmed that it will not build its second headquarters in New York. As we reported last week, the company was concerned about mounting opposition from some lawmakers and advocacy groups. In a statement, Amazon said, quote, "While polls show that 70% of New Yorkers support our plans and investment, a number of state and local politicians have made it clear that they oppose our presence and will not work with us to build the type of relationships that are required to go forward with the project we and many others envisioned in Long Island City," end quote. Critics of the decision did not like the tax breaks that Amazon was given to build the project that it estimates would have brought 25,000 jobs and billions of dollars in tax revenue to the city. We have two reports tonight. Dinah Olek on what that decision could mean for property values in the area. But first, Contessa Brewer with reaction from Long Island City.
On this holiday devoted to love, no love lost in New York City as neighbors and local politicians duked it out, and Amazon announces it's pulling out from its New York City deal. This was supposed to be the largest economic development deal in New York State's history, a deal that would bring 25,000 to 40,000 jobs that would average $150,000 a year. New York Governor Andrew Cuomo is pointing the finger at local leaders for ending this deal. A small group of politicians put their own narrow political interests above their community. One of those outspoken opponents was local New York City City Councilman Jimmy Van Bramer, and he did a victory lap news conference.
We are proud that we fought for our values. Proud that we fought for our values. Our values in New York City are to defend working men and women.
But the constituents who live here, neighbors and local businessmen, are furious.
Job killer, everybody!
They feel like they've lost out on the opportunities, and they pushed back loudly during that news conference.
I think it's a sad day for the community. I really do. There were a lot of jobs coming our way. There was a lot of energy in the community. And it's just unfortunate, there were a couple of politicians who made a lot of noise, and they did not speak for the residents in this community.
Amazon praised both New York's governor and the mayor, Bill de Blasio, for being good partners. But today, in his statement, Bill de Blasio somewhat changed his tune. He said, "We gave Amazon the opportunity to be a good neighbor and do business in the greatest city in the world. Instead of working with the community, Amazon threw away that opportunity." Amazon said it had 70% support among New Yorkers, but those 30% who opposed were loud in their opposition. They wanted to know what the impact would be on transit, on schools, on real estate, and they felt like Amazon wasn't being a good community partner in sitting down and talking with them. And so, on this Valentine's Day, New York City got dumped. Contessa Brewer, Nightly Business Report.
Now, when Amazon did first announce its choice of Long Island City for its second headquarters, we reported that buyers were flocking to buy up real estate in that area. Now what? Dinah Olek takes a look.
In the 14 weeks following Amazon's announcement to put HQ2 in Long Island City,
yes, so this entire cube is sold out.
Open houses like this one were jam-packed, some hoping to live there, others investors hoping to buy, flip, and profit from what would surely be a jump in home prices. Signed contracts to buy properties, mostly condos, jumped 181% compared to the same period the previous year, according to Stribling and Associates. 135 sales compared to just 48 the year before. When the news hit today, shares of residential REITs like Equity Residential and Avalon Bay took a hit. Avalon has a large building in Long Island City, and Equity Residential has a big presence right across the river in Manhattan. Long Island City's rental market was considered overbuilt before Amazon, with several new towers on the water. In a statement, the president of New York's real estate board, John Banks, said it's unfortunate that we've lost out on an opportunity to create tens of thousands of jobs for city residents and generate billions of dollars in tax revenue. Nevertheless, New York City is still open for business and will retain its status as a world-class center for tech and innovation. Office REITs were split today, with SL Green getting hurt initially as it has a large presence in Manhattan. But JBG Smith, the biggest office name in Northern Virginia, the other Amazon choice for HQ2, got a bounce. Some may be thinking that Amazon will now go even bigger in Northern Virginia. For Long Island City, it's not as if it will suddenly become a wasteland. Agents there say all the attention over the last few months was very positive and will likely outlast the Amazon effect. For Nightly Business Report, I'm Dinah Olek.
Today, investors got another surprise. Retail sales for the holiday season were a lot weaker than expected, posting their worst monthly plunge since 2009. And that caused the stocks to jolt lower at the open. And after a volatile day, the Dow Jones Industrial Average fell 103 points to 25,439. The Nasdaq was up 6, and the S&P 500 was down 7. And that sharp drop in retail sales is raising questions about the economy. Steve Leisman has more.
The largest monthly decline in retail sales in 9 years, reported today by the government, raised new questions about the outlook for the economy this year, with specific concern about whether the American consumer is weaker than originally thought. In data that was delayed by the shutdown, the government reported that retail sales for December plunged 1.2%. Wall Street had expected a 0.1% gain. The report, which covers the critical Christmas selling season, showed sales decline in most major categories, including department stores and gasoline stations. The numbers for internet retailers were even negative. Fed Governor Lael Brainerd, in an exclusive CNBC interview, said the data added to a growing list of concerns she has about the economy.
Certainly caught my eye. It's a miss. It's 1 month of data, so don't want to take too much signal from it, but certainly adds to a story where we want to take on board that there's some downside risks. At the same time, we're still getting pretty good numbers, more recent numbers on payrolls.
The big retail miss prompted economists to slash their outlook for fourth quarter growth by 0.7 of a percentage point to 2.4%. That would make it the weakest quarter since the first quarter of 2018. But there were questions about whether too much was being made of the one retail number because of some unique events.
The consumer was losing momentum going into this final number for 2018, but it also reflects the government shutdown, or at least the initial days of the government shutdown. So the question is, does this weakness reflect a bigger issue in terms of the consumer pulling back, or is this temporary weakness and we should expect a rebound as we wait for those January and/or February figures?
Brainerd said the retail number reinforced her support for the Fed's current policy stance, which is to be on hold. She said, quote, "I'm comfortable waiting and learning." For Nightly Business Report, I'm Steve Leisman in Washington.
Well, let's turn to Andrew Holland right now for his analysis of this data. He is the chief U.S. economist at Citi. Andrew, thanks for joining us tonight.
Thanks very much, Bill.
Everybody's got their opinion about what this number meant. It's only 1 month, but it was a huge miss. What do you make of it?
It's an ugly surprise for Valentine's Day, unfortunately. This number was a lot weaker than we were expecting, but I think you have to be careful here. I think as an economist, you're always trying to separate what is an aberration from the trend and what is telling you something about maybe a new trend that we're moving to. And the trend has been very strong. Strong job growth, strong income growth, and that's been driving strong consumption growth. We saw that in November. You had this weakening in December now in this one report, and so I would agree with Governor Brainerd that you have to take it seriously. It injects some downside risk to the forecast. But in terms of, is it telling us something really different about the strength of the consumer? I don't think we can conclude that, at least not yet. Everything else that we're seeing is still sending a message of strength. Okay. There are some special factors here. The shutdown, what happened in equity markets. So we're really keeping a fairly optimistic view on growth. Again, it's been a strong economy, very aberrant reading in this one report, but doesn't change our view.
Okay, so it doesn't change your base case scenario. Does it change what you think the Fed will or will not do in the future based on this data point?
So I think the good place that the Fed is in right now is they've already clearly signaled that they're on pause, probably at least for the first half of this year. Certainly after this data report, you want to wait. You want to wait for some of this delayed data to come back in and see where the consumer is, where the economy is. But can the Fed get back to hikes? I think they still can. I think that can happen towards the end of this year. You're going to have to see stronger data, though.
But so you're not changing your outlook for the economy. But I know that a couple of reports I saw today, one from a Federal Reserve Bank, a local one, and another from a brokerage house, both rather sharply reduced their expectations for GDP in this current quarter. And one I saw go from 2.7% all the way to 1.8%. What do you make of those?
So I think 2.7 to 1.8 is maybe a little aggressive, but this is really talking about the Q4 data, what happened in December. Yes, we revised down our growth expectation also from the higher 2% to now the mid 2%. So those Q4 growth estimates are going to come down. But remember, this is where we're talking about a 2% plus economy here. Right. We think that this can reaccelerate as you get into the second quarter, especially. First quarter is going to be dragged by some of these effects. So I think it still is an outlook for strong growth. And really, this is, backward-looking Q4 and likely to get some rebound in coming quarters.
We will see. Andrew Holland Horst of Citi, thanks again for joining us tonight.
Thanks so much.
And now Michael Farr joins us to talk about the stock market's reaction to the data. He is president of Farr, Miller & Washington. Welcome back, Michael. Nice to see you. So what did you make of the market's reaction to the data? A lot of people thought it could have been much worse.
I thought it could have been much worse, Sue. In fact, I thought that the markets behaved kind of responsibly today, almost like adults, which we didn't see a lot in 2018 with all of the volatility that we did see. I think Steve, in his interview with Governor Brainerd earlier today, brought up some really important points. But one of the things that was, I think, clear was that the consumer data or the retail data was weak, but I don't think necessarily the consumer's weak. Unemployment is still remarkably low. We're seeing wage gains. There's a lot of other important data that says that the consumer could continue to spend. But the consumer was facing a Washington crisis shutdown with 800,000 people out of jobs. And then we saw that drop in the stock market, Sue. When you see your portfolio statement go down 20%, you're saying, maybe I'm not going to spend a lot now. It doesn't mean that you can't. It means that you won't. It's different than people being out of work.
But we have come back quite a bit in January and throughout most of 2019. Yeah. I mean, we did have the worst stock market decline for a December since the 1930s, but we have come back. Right. Now what do you think happens now that we're getting these signs that maybe there is a little weakness going on here?
Yeah, I think you have to pay attention to the weakness. If we take a look at, of course, interest rates, and we've got an interest rate on the 10-year at 2.65%, still very low interest rates. As we look to next year and the following year, maybe 2.3, 2.4% GDP growth in 2019 is what the Fed is sort of looking for, and then still 2% in 2019. So it's not awful. Nothing's really awful, but I think caution after you've seen a market that's gone up 17%.
Michael Farr with Farr, Miller & Washington. Thank you, Michael.
Thank you.
To earnings now. Coke was a big loser on Wall Street today. In fact, it suffered its biggest decline since 2008 after the company said it expects sales to slow this year. And that overshadowed a slightly stronger than expected revenue number in its latest quarterly report. The stock fell sharply, down more than 8% today. Sarah Eisen spoke to Coke's CEO and filed this report.
Coca-Cola saw another strong quarter of growth, but didn't paint the rosiest picture of the future. CEO James Quincy says it's the economy that has them so cautious.
As we look into 2019, clearly we see softness in some of the countries that stumbled a little towards the end of 2018. Argentina went down strongly at the back end of last year. Turkey's now adjusting to some of their macroeconomic troubles, some of the other countries in the Middle East. And of course, Europe has softened a little bit coming into 2019. So I think it's not one country in particular. There's, I think, a few parts of the world that are softening. They're clearly represented in the IMF economic outlooks. But again, the good years and the bad years will come. What we're focused on is really executing against that plan. We've got good brands, good marketing, good innovation, and our bottling system is executing.
Coca-Cola's underlying business is strong, fueled by double-digit growth in Coke Zero Sugar, a return to growth for Diet Coke after years of underperformance, alternative sparkling waters like Topo Chico, and experimentation with new flavors like blueberry acai Diet Coke and a brand new version of Coca-Cola, orange vanilla.
I think around the world you're seeing consumers more interested in personalization, more interested in trying new flavors of brands they love. And so you see that in the US with new flavors on Coke, new flavors on Diet Coke. Clearly it's been part of helping stabilize the Diet Coke business, along with packaging and some great marketing. So I think you'll see more from us in terms of innovation, not just around new brands and new products, but also on new flavors.
But ultimately, Coke's fortune is tied to that of the global economy. It operates in more than 200 countries around the world. Therefore, the strength of the U.S. dollar does weigh on those profits when brought back home. And if the economy turns in places like emerging markets, Coca-Cola feels it on the spending side. For Nightly Business Report, I'm Sarah Eisen.
It is time to take a look at some of today's upgrades and downgrades. ExxonMobil was upgraded to outperform from underperform at Macquarie. The analyst says Exxon is well positioned for the future and cites its liquefied natural gas developments and its Permian Basin operations, among other things. The price target is $83. The stock rose 2 cents to $76.27. D.R. Horton was downgraded to market perform from strong buy at Raymond James. The analyst cites the macro housing environment for the year. The firm also noted the stock's valuation. The shares fell about 1% to $39.80. Dunkin' Brands was downgraded to hold from buy at Argus. The analyst cites the outlook for same-store sales growth. The firm also notes management's plan to add fewer stores. Shares rose about 1% to $69.87.
Still ahead, why trade talks with China are entering a crucial phase. In Washington, the Senate today passed legislation that would avert another partial government shutdown. The House is expected to vote on that bill tonight. Then it goes to the president.
I've just had an opportunity to speak with President Trump, and he, I would say to all my colleagues, has indicated he's prepared to sign the bill. He will also be issuing a national emergency declaration at the same time. And I've indicated to him that I'm going to support the national emergency declaration.
House Speaker Pelosi said that she may mount a legal challenge if a national emergency is in fact declared. Senate Minority Leader Chuck Schumer called such a move a lawless act.
And when it comes to trade, the focus is on Beijing, where officials from the U.S. and China are trying to hammer out their differences to avoid an escalation of the tensions between the world's two largest economies. Eunice Yoon has been covering the story for us all along, and she's back tonight with more.
Today was a key day for the trade talks. All the major players, Treasury Secretary Steven Mnuchin, Trade Representative Robert Lighthizer, and China's Vice Premier Liu He, were meeting for their first day of 2 days of discussions. Expectations are growing that the two sides are trying to hammer out the framework of an agreement that would act as a basis for a potential summit between President Trump and President Xi later, possibly as early as next month. There's a feeling that the final decisions would be made by the two leaders if they do meet. From what we know, a lot is on the table, but the negotiators are still far apart on how to address stickier structural issues and enforce a deal once it's worked out. But the two sides might get some more time. Bloomberg is citing sources as saying that President Trump is considering a 60-day extension to the March 1st deadline. Separately, we got trade data out of China that gives us a good look into the impact of the tariffs on the trade relationship between the U.S. and China. And it's not necessarily what you might think. Chinese exports to the U.S. in January were down, but up overall by more than 9%. Greater shipments to Japan, Europe, as well as Southeast Asia. What was even more interesting is how sharply imports to the U.S. fell. by 41.2%. That raises questions as to who is and who is not being affected by the tariffs. It's only 1 month's data, but the data shows that American exporters are getting hurt more severely than Chinese ones. It also lends to the argument that you often hear in China, within the business community here, that even though the U.S. is an important market for China, it has limited influence because China can just export to the rest of the world. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Elsewhere, coming off a dramatic year, CBS reported fourth quarter results that missed Wall Street earnings and revenue estimates, largely due to its entertainment unit and tough comparisons to last year, which was very strong. That sent the stock initially lower in after-hours trading. But as Julia Borston reports, one part of the business is strong.
The key takeaway from CBS earnings, while revenue and earnings grew slower than expected, the company's direct-to-consumer streaming business is growing faster. Acting CEO Joe Iannello saying the company's streaming apps, CBS All Access and Showtime, have significant momentum, saying they provide a great return on investment and represent one of the company's most powerful long-term growth drivers. Iannello announcing they have 8 million direct-to-consumer subscribers between CBS All Access and Showtime, nearly 2 years ahead of original projections. As a result, Iannello says they're increasing their target to 25 million domestic subscribers for these services by 2022. That's up from projections made in August of 16 million subscribers by then. Iannello saying they're steering their strategic focus towards scaling direct-to-consumer subscribers. For Nightly Business Report, I'm Julia Borston in Los Angeles.
NVIDIA beats earnings estimates, and that's where we begin tonight's market focus. The chipmaker closed out a turbulent year with better than expected profit and revenue that was in line. But the company is forecasting first quarter revenue below estimates as it faces slowing sales to data centers and weak demand for its gaming chips. Shares initially popped in the after-hours trade following a 1% gain during the regular session where they closed at $154.53. Six Flags investors took on a ride today, quite a ride, as the earnings beat estimates by a wide margin, but revenue came up short. The theme park operator was hurt by challenging economic conditions in China, which pushed back some park opening dates there. Shares plummeted almost 13% today to $54.87.
Restaurant chain operator Bloomin' Brands topped earnings and revenue expectations, and it provided upbeat full-year outlook as well. The solid results were helped by Outback Steakhouse, which posted gains in same-store sales and customer traffic. Shares jumped 9% for the company to $21.06 today. Yeti also beat on quarterly earnings and revenue and gave positive guidance for 2019. That company, which makes coolers and mugs, said that the growth was driven by expanded drinkware products. Yeti came public just last October, and shares were surging 17.5% today to $21.90. And eBay is reportedly planning to lay off workers as it restructures its regional operations. The online marketplace has faced strong competition from the likes of Amazon and other online retailers. eBay currently employs more than 14,000 people. The stock was up just a fraction today at $36.32.
Coming up, why the world's largest passenger jet is being grounded. Southwest received approval from the FAA for test flights to Hawaii. The airline still needs full FAA authorization before it can announce when it will start passenger flights. This is considered a key step in the approval process for a new route. As we reported, that process was delayed earlier this year because of the partial government shutdown.
Well, the world's largest commercial airplane is flying into the sunset. Airbus has decided it's going to stop building that massive A380 due to a lack of orders. Phil LeBeau has more on the big plane that failed to meet big expectations.
The death of the Airbus A380 is not a surprise. Aside from Emirates, which is based in Dubai, demand for the massive jumbo jet never really took off. And with orders dwindling, Airbus has decided to stop building the plane.
The decision we had to take on the 380 is a painful decision, but this will not impact Airbus's competitiveness in the market.
This is not what Airbus envisioned when it delivered the first A380 in 2007, a double-decker plane carrying 400 to 600 passengers on long international flights was supposed to be the perfect plane for a global surge in air travel. We've seen that surge, with more than 4 billion people taking off every year. But instead of ordering more A380s, airlines have opted for smaller, more fuel-efficient planes, like Boeing's 787 Dreamliner, which has the size and range to connect a wider variety of cities around the world. Not surprisingly, 787 orders and deliveries have steadily climbed higher, while the A380 has struggled. A disappointing return on Airbus's $25 billion investment in the plane.
We put a lot of resource into the 380 over many, many years. The decision today means the end of production, but not the end of a program. By the way, we will continue supporting the 380 for many, many years to come.
In fact, Airbus expects the A380 to be in service well past 2030, connecting mega hubs like London, New York, and Mumbai. But for many other cities around the world, the A380 will never be the right fit. Phil LeBeau, Nightly Business Report, Chicago.
And finally tonight, Fortune is out with its list of the best companies to work for, evaluating everything from perks to opportunities for innovation. Climbing to the #1 spot is Hilton, up from number 33 last year. Hilton is the first hospitality company to achieve a #1 ranking. Salesforce, #2, down 1 notch from the top spot last year. And rounding out the top 3 is family-owned grocery chain Wegmans, which has been on that list for 22 years. Wow.
Yep.
That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Thanks you for joining us, and have a happy Valentine's Day as well.
Yes, indeed.
We'll see you tomorrow.